I've watched thousands of people destroy their financial lives, not because they lacked money, but because they fundamentally misunderstood what money actually is. They treat $100,000 like it's either nothing or everything, when the mathematical reality is far more precise. Most people think freedom requires millions, but I'm going to show you why that belief is not just wrong. It's statistically provable nonsense that keeps you trapped in a system designed to extract your time and capital. Let me be direct. If you have $100,000 today and you feel broke, the problem isn't your bank account. The problem is that you're running faulty code in your decision-making process. You're using emotions where mathematics should govern. You're following cultural programming instead of logical analysis. And most critically, you're measuring wealth by the wrong variables entirely. I spent decades building mathematical models to extract patterns from financial markets. The most profitable insight wasn't about stocks or bonds. It was about human behavior and the systematic errors people make with capital. The traditional approach to money, the one sold to you by every financial institution and advertised lifestyle, is fundamentally broken. It optimizes for consumption instead of optionality. It maximizes expenses instead of operational efficiency. And it completely ignores the single most important equation in personal finance, the one that determines whether you are actually free or just pretending to be. Here's the thesis I'm going to prove to you today. $100,000 represents a critical threshold, a phase transition point where the mathematics of your life completely changes. But only if you understand three specific mechanisms that separate those who use money as a tool for freedom from those who remain enslaved by their own spending patterns. These aren't motivational concepts. These are mathematical realities that function regardless of your feelings about them. The first fatal error people make is confusing income with wealth. I've seen this destroy more financial lives than market crashes ever could. Someone making $200,000 per year thinks they're wealthy. But when you run the actual numbers, when you calculate their burn rate, their fixed obligations, their time cost, you discover they're operating at near zero optionality. They've built a financial structure that requires constant input to prevent collapse. That's not wealth. That's a high-paying job with expensive handcuffs. Let me give you a concrete example that illustrates this principle. Imagine two people. Person A makes $300,000 annually. They live in an expensive neighborhood because that's what successful people do. They drive a car that costs $70,000 because image matters in their profession. They have a mortgage that demands $6,000 per month. Add in property taxes, insurance, the second car, private schools, the lifestyle maintenance costs, and you're looking at monthly fixed expenses around $15,000. That's $180,000 per year just to maintain their baseline existence. After taxes on that $300,000 income, they're saving perhaps $40,000 to $50,000 annually, assuming perfect discipline, which most don't have. Person B makes $80,000 per year, but they've optimized their expense structure. They live in a modest place where rent is $1,400 monthly. They drive a reliable used vehicle they purchased with cash. Their total fixed monthly expenses are around $3,000 or $36,000 annually. After taxes, they're keeping about $55,000 of their income and saving $20,000 per year. Now here's where the mathematics becomes interesting. Who reaches financial independence faster? Who has more optionality? Who can weather a job loss, a health crisis, or a market opportunity? The person making nearly 4 times as much income is actually in a weaker position. Their high income created permission to build an expensive life structure, and that structure now controls them. They need that job. They need that steady paycheck. One disruption and the whole system can collapse. The person with lower income but optimized expenses has more degrees of freedom. They can take career risks. They can wait for better opportunities. They can survive disruptions. Most importantly, they can reach that $100,000 threshold years faster. This is the trap nobody talks about. Every increment of lifestyle inflation you add creates a new baseline that feels necessary. The human brain is remarkably efficient at converting luxuries into requirements. You get a raise, you upgrade your living situation, and within 6 months, that upgrade feels like the minimum acceptable standard. This isn't a moral failing, it's basic neural adaptation, but it's financially catastrophic if you don't account for it in your decision model. The second mechanism people misunderstand is the nonlinear return curve of capital. $100,000 is not just a number. It's a mathematical inflection point where your relationship with money fundamentally changes. Below that threshold, you're trading time for money in a roughly linear way. You work more hours, you get more dollars. The system is simple and directly coupled. But once you cross $100,000 in liquid capital, something shifts. You now have enough mass to generate returns that begin to decouple from your time input. Let me show you the mathematics behind this. If you have $10,000 invested at a conservative 8% annual return, you're generating $800 per year. That's $67 per month. Essentially noise in most budgets. It doesn't change your decision space. But $100,000 at that same 8% generates $8,000 annually. That's $667 per month. Now we're talking about meaningful numbers. That covers a car payment, or significant grocery costs, or insurance premiums. But more importantly, it represents the beginning of a compounding system that can eventually replace your earned income entirely. The real power shows up when you understand the timeline. Let's say you're saving $20,000 per year. To get from 0 to 100,000 takes 5 years. But to get from 100,000 to 200,000, assuming that 8% return, takes only 4 years. Your savings plus the investment returns are now working together. From 200 to 300,000 takes roughly 3.5 years. The curve is accelerating. Each increment gets faster because the base you're earning returns on keeps growing. This is the compounding mechanism everyone talks about, but few actually experience because they never build that initial mass of capital. They spend the 20,000 on lifestyle instead of investing it in their freedom system. I've run these models thousands of different ways, adjusting for different return rates, different savings rates, different starting points. The pattern is always the same. There's a critical mass point where your capital starts generating meaningful returns, and $100,000 is approximately where that phase transition occurs for most expense structures. Below it, you're accumulating. Above it, you're compounding. They feel similar, but mathematically, they're completely different regimes. Here's what makes this even more powerful. Once you have that $100,000 base, your risk tolerance can actually increase in strategic ways. You can deploy smaller amounts, say $5,000 or $10,000, into higher risk, higher potential return opportunities. A business idea, a skill acquisition that could boost your income, a concentrated bet on something you've researched thoroughly. If it fails, you still have your base. You're not starting over from zero. This is what I mean by optionality. Capital creates choices. Choices create opportunities. Opportunities create more capital. But the system doesn't activate until you reach that critical mass threshold. The third fatal mistake is optimizing for the wrong variable entirely. Most people optimize their lives for comfort, status, or short-term pleasure. These are fine goals if your objective is to consume resources. But if your objective is freedom, you need to optimize for something completely different. You need to optimize for time sovereignty. This is the variable that actually matters, and it's the one almost nobody tracks correctly. Think about what money actually buys. It doesn't buy happiness. That's been proven statistically irrelevant after basic needs are met. It doesn't buy status. Status is a social game that's inherently relative and never satisfying. What money actually buys is time. Specifically, it buys your time back from the marketplace. Every dollar you have invested and generating returns is a small piece of your future time that you no longer need to sell. When you have enough of these dollars working for you, you reach a point where you don't need to sell your time at all. That's what freedom actually means in mathematical terms. Let me tell you about a concept I've found useful. I call it your freedom number. It's simpler than most financial planning models and more accurate because it focuses on the right variable. Your freedom number is the amount of capital you need to generate your annual expenses through conservative returns. If you spend $40,000 per year and you can reliably generate 4% returns after inflation, your freedom number is $1 million. If you spend $30,000 per year, your freedom number is $750,000. Notice what happens when you lower your expenses. Your freedom number drops proportionally. This is the lever that most people completely ignore. The standard financial advice says to increase your income, get a better job, negotiate a raise, start a side business, all fine suggestions, but they're attacking the problem from the difficult side. Your income is subject to market rates, competition, your skill level, your industry, your geography, and countless other external factors. Your expenses, on the other hand, are almost entirely under your control. You can cut your freedom number in half by optimizing your expense structure, and nobody can stop you from doing that. No boss needs to approve it. No market needs to cooperate. It's a direct action you can take today that immediately changes your mathematical trajectory. I've watched people spend decades chasing income increases while ignoring their expense optimization. They get that promotion from 80,000 to 120,000. Their savings rate goes from 12,000 per year to maybe 18,000 per year. A 50% income increase produced a 50% savings increase. Sounds good until you realize they could have achieved the exact same savings increase by cutting their expenses from 68,000 to 58,000. One required years of career development and performance excellence. The other required a weekend of analyzing their spending patterns and making some strategic cuts. This brings us to what you actually do with $100,000 once you have it. This is where most people fail catastrophically. They reach this threshold and immediately start thinking about what they can buy with it. A new car, a down payment on a bigger house, a luxury vacation. They've been operating in scarcity mode for so long that reaching six figures triggers a consumption response. This is the worst possible decision you can make, and it's entirely predictable based on human psychology. You've been delaying gratification to build this capital base. Your brain is screaming for a reward, but giving in to that impulse destroys everything you've built. Here's what you do instead. You treat that $100,000 like a manufacturing plant. It's not money to be spent. It's capital equipment that produces output. Your job is to protect that equipment and maximize its efficiency. This means investing it in a way that generates reliable returns with minimum volatility. For most people, this means a diversified portfolio of low-cost index funds. I'm not going to pretend there's some secret strategy that beats the market consistently. I've spent my career finding market inefficiencies, and I can tell you that for individual investors with under $1 million, the edge from active management rarely exceeds the cost you pay for it. Simple, broad, diversified, low cost. That's the mathematically optimal approach for this stage. But here's the critical part. Once that $100,000 is invested in generating returns, your psychology needs to shift. That money is no longer part of your available spending pool. It's locked into your freedom system. The returns it generates can eventually be used. But the principle is sacred. This is a one-way door. Money goes into the freedom system. It doesn't come back out until the system is fully operational and producing enough output to support your life. I've seen people break this rule countless times. They hit 150,000 and suddenly there's an emergency. Maybe it's real, maybe it's manufactured. They pull out 20,000. Then 6 months later, another situation arises. They pull out 15,000 more. Within 2 years, they're back at 80,000 or 90,000 and they've lost all their momentum. They have to rebuild that base again. Every time you break the integrity of your freedom system, you reset your timeline. The math doesn't care about your reasons. It just compounds based on the capital you actually have invested. Let me share a framework I've found useful for thinking about financial decisions. Every choice you make with money falls into one of three categories. Category 1, consumption. This is spending that produces no future value. Entertainment, food beyond basic nutrition, most forms of convenience. Category 2, capital preservation. This is spending that maintains your current operational capacity. Housing, basic transportation, healthcare, essential insurance. Category 3, capital appreciation. This is spending that increases your future capacity. Education that boosts your income. Tools that improve your efficiency. Investments that generate returns. Most people operate with roughly 70% consumption, 25% capital preservation, and 5% capital appreciation. They're stuck in an equilibrium where their life never really improves. The people who reach financial freedom reverse these ratios. They drive capital appreciation up to 30 or 40%, keep capital preservation around 30%, and cut consumption down to 30% or less. This isn't about deprivation. It's about recognizing that every dollar spent on consumption today is a dollar that can't compound for your future freedom. You're making a trade, and most people make that trade unconsciously without ever calculating what they're actually giving up. Here's a specific example to make this concrete. You're deciding whether to spend $5,000 on a luxury vacation. Category 1, spending, pure consumption. It produces memories and temporary pleasure, then it's gone. Alternatively, you could invest that $5,000 in your freedom system. At 8% returns, that $5,000 becomes approximately $73,000 after 30 years. But more importantly, it becomes part of the base that's generating monthly returns right now. $5,000 at 8% produces $400 annually, or $33 per month, forever, every month for the rest of your life, assuming you don't touch the principal. So the real question is not whether a $5,000 vacation is worth $5,000. The question is whether a week of travel is worth $33 per month for the rest of your life. When you frame it that way, the mathematics becomes much clearer. Some people will still choose the vacation, and that's fine. But they should make that choice knowing the actual trade-off, not just the upfront cost. This is how every financial decision should be evaluated once you're building your freedom system. Not what does it cost today, but what optionality am I giving up tomorrow? This is opportunity cost thinking, and it's the foundation of rational resource allocation. Every dollar has multiple possible uses. Your job is to deploy those dollars to the highest value use based on your actual objectives. If your objective is maximum immediate pleasure, spend freely. If your objective is freedom, the calculation is completely different. Now, let's talk about the psychological dimension, because this is where even mathematically sophisticated people fail. Building to $100,000 requires sustained discipline over multiple years. The human brain is not well designed for this kind of delayed gratification. We evolved in environments where resources were scarce and the future was uncertain. Consuming immediately made sense. Storing resources often meant they'd spoil or be stolen. Our neural wiring reflects that evolutionary history. You're fighting against millions of years of programming that says spend it now, tomorrow might not come. The solution is not willpower. Willpower is a finite resource that depletes with use. Instead, you need systems that make the correct behavior automatic. The most effective system I've seen is what I call the priority allocation model. On the day you receive income, before you see it in your main checking account, a predetermined percentage is automatically transferred to your investment accounts. You're paying your freedom system first, not last. What remains in your checking account is what you have available to spend. This removes the decision point. You never have to exercise discipline or willpower because the correct action happens automatically. Most people do the opposite. They receive their income, they spend on whatever comes up during the month, and then they try to save whatever's left over at the end. This fails for obvious reasons. There's always something left over at the end of the month, and that something is usually close to zero. Expenses expand to consume available resources. This is known as Parkinson's law in a financial context. By removing the money before you can spend it, you force your expenses to fit within a smaller container. And Because humans are remarkably adaptable, you adjust within a few months. The lower spending level feels completely normal. I recommend starting with at least 20% of gross income going directly to investments. If you're early in your wealth building phase, 30 or 40% is better. I've seen people sustain 50% savings rates for years once they build the right systems and mindset. It sounds extreme until you realize that cutting your freedom timeline in half might mean retiring at 45 instead of 65. 20 years of your life, that's what we're actually talking about here. 20 additional years where you control your time instead of selling it. When you frame it that way, living on 50 or 60% of your income suddenly seems like a bargain. The other psychological trap is comparison. Humans are intensely social creatures. We constantly evaluate our status relative to others. When your colleagues are driving new cars and taking expensive vacations and you're driving a 10-year-old vehicle and cooking at home, your brain interprets this as low status. It's uncomfortable. It creates psychological pressure to conform to the spending patterns around you. This is why your peer group has such a massive impact on your financial outcomes. If you surround yourself with people who optimize for consumption, you'll be pulled toward consumption. If you surround yourself with people who optimize for freedom, you'll be pulled toward freedom. The solution is to be deliberate about your information environment. Stop following people on social media who showcase expensive lifestyles. Stop reading magazines and websites that promote consumption. Start engaging with content and communities focused on financial independence and rational resource allocation. This isn't about being antisocial. It's about recognizing that your environment shapes your behavior more than your conscious intentions do. You can have the best logical framework in the world, but if you're constantly exposed to messages that say, spend more, buy this, upgrade that, your behavior will drift toward consumption regardless of your intellectual understanding. Let me address a common objection I hear. Some people say this approach is too extreme, that you're sacrificing your youth and your present happiness for some distant future that might never arrive. Life is short, enjoy it now. This argument sounds reasonable until you examine the mathematics of happiness research. Studies consistently show that happiness increases with income, up to about $75,000 to $80,000 annually, and then it plateaus. Additional income beyond that threshold produces minimal additional happiness. What does continue to increase happiness is autonomy, control over your time, and freedom from financial stress, all of which come from having capital, not from having high consumption. The person spending $100,000 per year is not twice as happy as the person spending $50,000 per year. But the person with $200,000 invested is dramatically more secure, more free, and more capable of handling life's uncertainties than the person with zero invested. The math is not controversial. The research is clear. Yet most people ignore it because it conflicts with the cultural programming that says more spending equals better life. It doesn't. Beyond a fairly modest threshold, more spending just equals more stuff and higher fixed costs. Here's what actually happens. When you reach $100,000 invested and you continue building from there, your stress levels decrease. You sleep better. You make better decisions because you're not operating from financial desperation. You can be more selective about career opportunities because you're not forced to take the first offer. You can invest in relationships and health because you have time and resources. You can pursue projects that interest you even if they don't pay well immediately because you have a financial foundation. This is what freedom actually looks like. It's not yachts and mansions. It's optionality and reduced anxiety. It's knowing that you can weather storms. It's having choices. The final piece I want to address is the timeline question. How long does it actually take to reach $100,000 starting from zero? The answer depends entirely on your savings rate. If you save $10,000 per year with an 8% return, you'll hit $100,000 in about 8 years. If you save $20,000 per year, you'll get there in 4.5 years. If you can push it to $30,000 per year, you're looking at 3 years. These are not impossible timelines. These are achievable goals for anyone with a middle-class income and reasonable expense discipline. The key insight is that the timeline is under your control. You can't control market returns, at least not reliably. You can't control your income growth with perfect precision. But you can control your savings rate almost entirely. This is the variable you optimize. And the beautiful thing about focusing on the controllable variable is that it produces psychological benefits immediately. You're taking action. You're making progress. Every month you see the numbers increase. This creates momentum and reinforces the behavior. I've watched people transform their financial lives in 5 years or less by simply taking this seriously. Not through luck, not through high-risk speculation, not through inheritance, through systematic application of basic mathematical principles. High savings rate, low expenses, consistent investing, long time horizon. That's the formula. It's not complicated. It's not sexy. It doesn't make for exciting stories, but it works with near certainty if you execute it consistently. Let me leave you with this final thought. $100,000 is not the end goal. It's the beginning of real financial capability. It's the point where your capital starts generating meaningful returns. It's where you transition from accumulation mode to compounding mode. It's where you begin to experience what financial freedom actually feels like. But you only reach it by making decisions that look irrational to people around you. Driving older cars, living in smaller places, skipping purchases that feel normal and expected, taking your lunch to work, optimizing every significant expense category. These decisions feel like sacrifice when you're making them, but they're not sacrifice. They're investment. You're investing in a future where you control your time, where you don't need permission to take a month off, where losing your job is an inconvenience, not a catastrophe, where you can pursue work you find meaningful rather than work that pays the most. This is what $100,000 buys. Not the things you can purchase with it, but the freedom it generates through compound returns. So here's what I want you to do. Leave a comment below telling me one specific action you're going to take in the next 7 days to move toward your $100,000 goal. Not a vague intention, a specific action. Are you going to calculate your current savings rate? Are you going to set up automatic transfers to an investment account? Are you going to analyze your 3 biggest expense categories and identify cuts? Are you going to sell something you don't need? Whatever it is, make it concrete. Make it measurable. Make it time-bound. And if you found value in this breakdown, hit that like button. It tells me this approach resonates and I should continue developing content in this direction. The mathematics of financial freedom is not mysterious. It's not reserved for the wealthy or the lucky. It's available to anyone willing to make logical decisions consistently over time. $100,000 is your first major milestone. Reaching it changes everything about how money works in your life. The question is not whether you can get there. The question is whether you're willing to make the trade-offs required to get there. Most people are not. They'll watch this video, they'll nod along, and then they'll continue spending at their current rate because it feels normal. But normal is why most people never build wealth. Normal is why most people work until they're 65 or 70. Normal is why most people have almost no control over their time. You have a choice. You can optimize for normal, which means consumption and comfort today at the cost of freedom tomorrow, or you can optimize for freedom, which means strategic discomfort today in exchange for decades of sovereignty later. The mathematics is clear, the path is defined, the only variable left is your decision. What are you optimizing for? Because that decision, made consciously or unconsciously, will determine the entire trajectory of your financial life. Make it deliberately, make it logically, and make it based on what you actually want your life to look like 10 years from now, not what feels comfortable in this moment. That's how you build real wealth. That's how you achieve actual freedom. And that's how you join the small percentage of people who understand that $100,000 is not just money, it's the mathematical foundation of a completely different kind of life.